negative gearing and what it actually means to have negatively geared properties, and then how that can affect you buying more properties and also your current cash position. So negatively geared just simply means that the property costs you money every single week. So if you're looking at building a large property portfolio and you don't have like a massive income, you're going to need to rule out negatively geared properties just straight off the bat. Unless you've got hundreds of thousands of dollars or millions of dollars of income, rule out negatively geared properties because they're going to hinder your growth. So when you first start, especially, you need to be buying positively geared properties. And if you've got, an average income, $100,000 or, under $100,000, do not buy negatively geared properties. There's a way to actually structure positively geared properties so that even if you're on a very modest income, you can still continually keep buying properties. Now, there are some other creative strategies that you can still use even with negatively geared properties to be able to continually buy properties. But you still need to be able to service the debt, the actual debt. But when it comes to serviceability, the bank takes the rate that they're offering you, even if it's an interest-only loan, which a lot of loan facilities are only interest-only, then they take that interest and they assume that you've got to be paying principal and interest on the loan, and then they add about another 3% on top of that loan rate. So at the moment we're at 6% interest rates, give or take. So the bank's going to be assessing you at 9% interest rate, as in you repaying back the loan plus 9% interest, and they're going to be assuming you're paying the principal and interest over whatever the loan term is, 25 or 30 years. So that's going to affect your serviceability substantially. And one thing that I heard just today as well is the expense ratio has changed as well. So banks like to change their policies with how much expense that they will assume a borrower has. So just even in the last 3 or 4 months with one of the loan facilities that I have, the bank assessed my expenses at a reduced level. Now they're taking it at quite a heightened level beyond what it was assessed before.